topic of today's lecture is depreciation. Let us first understand what is depreciation. Depreciation is reduction in the value of assets because of usage and passage of time. And in case of a business, it's very important that we, while calculating the cost of products or while calculating the profit or loss incurred during a particular year or during an accounting period, we must calculate depreciation. Why? Because the other cost, like cost of purchases, cost of other expenses, we already have taken in our books. But one thing, we have used so many fixed assets in the business. Have not they reduced in value? They have. So their reduction during the accounting period should be taken into account while finding out the profit and loss for the business. Isn't it? If we don't do it, now what will happen because of this? For example, you don't charge depreciation, okay, and that amounts to say 20,000 rupees in a particular year, for example. Now if you don't charge this 20,000 rupees to your profit and loss account, your profit will be enhanced by 20,000. They will increase by 20,000. And because of that, what will happen? You may make drawings or you may make dividends more by 20,000 because you feel you have earned 20,000 more because you have not considered depreciation in your books. This one thing could happen. Second is, your balance sheet shows the fixed assets at enhanced values, at increased values. Their book values must reduce for the simple reason because naturally now their intrinsic value or their utility to the business has reduced because of usage and passage of time. Is that right? Now, thirdly, if we don't consider depreciation, the cost of production of our products, or put it in the nutshell, the cost of our products will be very less as compared to if we take depreciation into account. Now because of that, we may sell our products at sometimes even below cost because we have not considered depreciation, or we may not add a proper margin. And this will all lead to depletion of our capital over a long period. If we don't charge depreciation, a time will come when our fixed assets will not be of much use in our business. Commercially, they will be over the hill. But we won't have money to buy other assets because we have not charged depreciation. And because of that, we have over withdrawn or overpaid dividends. So because of all these reasons, it's very necessary that we charge depreciation. I hope I have made my point very clear. Is that right? Okay. Now let us see how we can calculate or compute depreciation. There are several methods. But in this lecture, I will be talking about only two methods. One is straight line method or fixed installment method, and the other is reducing balance method. The other methods like annuity method, sinking fund method, or say sum of digits method, all these methods I will be telling you about in the next lecture. In this lecture I will be concentrating only on those two methods. Now first of all, let us see how we compute depreciation in case of straight line method. Now first of all, let me tell you, for computing depreciation, we need to know only three things. Number one, the historical cost of the asset. Historical cost of the asset means the price at which we bought it, plus all the expenses paid by us to bring that to our premises. That could be freight, taxes, okay, and any other thing which we have paid for buying this machine. But it does not include finance charges, okay. And when we have brought this machine to our premises, machinery to our premises, the installation charges all the expenses paid by us to install it in our premises will be capitalized. That means they all will be charged to asset account. They will be debited to asset account. And by chance, if you buy a second-hand machinery, all the expenses spent on making that machinery workable will be debited to machinery account. This you must remember. So first thing is, we must know the historical cost of the machinery or whatever the asset. Number two, its life. Now life could be its commercial life, or could be legal life. Sometimes some assets have their legal life. Maybe beyond that period you can't use them, even if they are in the working condition. Okay? Or sometimes we estimate life. We estimate on our engineers on technical basis tell us that okay, this machine will last that many years or that many hours. Even manufacturers tell us this information in their brochure, etc. So we need to know its useful life. It could be any of the three: commercial, or estimated, or legal life. Number three, we must know its scrap value at the end of its useful life. Scrap value here means at what price we estimate we will be able to sell this machine after its useful life is over. If we know all these three facts, we can compute depreciation. Let us see first fixed installment method or straight line method. Straight line method. Now, for example, you buy a machine for say rupees 1 lakh, and you spend on its freight say 10,000 rupees, and on its installation you spend say 30,000 rupees. So that means its cost to us is 1,40,000. And we estimate that the end of its useful life, it can be easily sold for say 20,000 rupees. So that is to be reduced from this. So less scrap value. This is scrap value, say 20,000. So this means this 1,20,000 rupees we have to spread over its useful life. And if its useful life is 10 years, if its useful life is 10 years, then depreciation to be charged per year will be how much? This 120 divided by 10. That means 12,000 rupees per annum. That means annually we must charge 12,000 rupees as depreciation on this machinery. We call it fixed installment method also, because fixed installment, this fixed 12,000 will be charged as depreciation every year. This can be represented as a percentage also. This 12,000 can be represented as a percentage of 140. Then percentage depreciation 12,000 upon 1,40,000 into 100. Okay, whatever it comes. Around 8.6% per annum. Okay, that means when we will charge depreciation at the rate of 8.6% per year on this 1,40,000, at the end of 12 years, around, because I have approximated here, if I had not approximated, then it would have given you complete, it would have depreciated complete 1,20,000, and 20,000 would have been in the account. Okay, this is the way straight line method works. Is it clear? Okay, the merits of this method are, it's very simple to understand and very simple to compute. Okay, but its demerit is that, you know, in this method the depreciation per annum remains the same throughout its lifetime. But fact of the matter is that as the asset goes on increasing in life, the expenses on its repairs, upkeep, keep on going. So it means what? It means that it has a different kind of impact on profit and loss account. That means its impact on profit and loss account keeps on increasing with passage of time, because this installment remains same, but the repairs on this asset keeps on growing. So because of this, our cost keeps on distorting. So this is one aspect which you can say is its demerit. Okay. Now let us move to the other method. The other method is reducing balance method. In the reducing balance method, we charge depreciation each year on its reduced value. That means we charge depreciation whatever is the opening balance in our asset account at the beginning of the year. Now we will understand reducing balance method. In this method, the depreciation to be charged, that is what should be the rate of depreciation, is calculated through this formula. Here n is number of useful life years, okay, and S is scrap value at the end of useful life, and this is cost of the asset. So through this formula you can calculate the depreciation to be charged every year. As you see, it's a bit difficult to calculate through this method, but if you have scientific calculator or log tables with you, you can easily do this. Okay, but let me tell you, in exams, mostly since they don't provide calculators or log tables, they normally give you percentage to be charged. They normally don't ask you to calculate the percentage of depreciation, but you should be prepared for it. Formula is this. Okay, so how things work in this method, let us now understand how reducing balance method works. For example, we buy a machinery for rupees 1 lakh, and you are told that you have to depreciate this machinery at the rate of 10% per annum on reducing balance method. Then how much you will charge in the first year? Depreciation first year at the rate of 10% per annum. So this will be rupees 10,000, and 90,000 will be book value at the end of first year. And in the second year, how much you will charge depreciation? Naturally 10% of 90,000, that will be 9,000, and 81,000 will be your book value at the end of second year. And in the third year, your depreciation will be how much? Naturally 10% of 81,000, that is 8,100. Okay, so this is the way we charge depreciation in the reducing balance method. This method is not very difficult to understand. It's its merit, and at the same time this method is recognized by income tax authorities also. Third advantage of this method is that it balances out the impact of using that machinery on the profit and loss account. What I mean by this? You see, initially in this method the depreciation is higher. It goes on reducing year by year, isn't it? And at the same time, as we all know, that the repair expenses go on increasing year after year as the machinery goes on being used for number of years. So as this depreciation goes on reducing, the repair expenses go on increasing. So in nutshell, they balance out each other, and the impact on profit and loss account is same for each year. Okay, so this is the advantage of this method, but only disadvantage is that it's a bit difficult to calculate the rate of depreciation in this. Secondly, in this, the value at the end of its useful life may not come to its scrap value or zero as you. Now, having learned the methods of computing depreciation, let us now learn how to record depreciation. Okay, so whenever depreciation is charged, the journal entry for this is depreciation account debited to asset account, whichever asset, that account will be credited. Okay, this is mostly at the end of the year, but if you are by chance selling a machinery during the year, then you have to charge at the time of selling the machinery, but normally it is at the end of the year. Then this depreciation, being an expense, is to be charged to profit and loss account. So the next entry is profit and loss account debited to depreciation account. Okay, these are the entries which are passed every year, whatever the method. Okay, now let us see the posting of this. If this is our asset account, so if you buy this asset on say 1st January 2005, so on 1105 to bank for buying the machinery. For example, if you buy this for 1 lakh, and if you charge depreciation say 10,000 every year, this will be your entry. So what will be the posting of this? On 31/12/05 by depreciation 10,000. That's all. And then balance will be carried forward to next year by balance carried forward 90,000. And then posting will also be done to the depreciation account. This is your depreciation account. So here depreciation is being debited. So to asset account, maybe if it is machinery or whatever it is, 10,000. This is because of first entry. And at the end of the year, this will be shifted to profit and loss account according to this. So on 31/12/05 by P&L account 10,000. Unless there is a change in the asset account, if there are some more purchases or some sale of assets, this 10,000 will be charged every year, and depreciation account will look like this every year without fail. Okay. Now let us see how this asset account is maintained if there are more purchases, selling. Okay. Let us see. So on the next year, this will be brought down 1106. Okay, to balance brought forward 90,000. And if you buy a machinery, say on 1706 to bank, say 50,000. If you buy another machine for 50,000, and now at the end of this year on 31/12/06 you have to charge depreciation. How much you will charge? You have to charge depreciation again at the rate of 10% on fixed installment method. So naturally this machine is this one, so 10,000 for this. And what about this machinery? If it is for the full year, it would have been 5,000. But since you have bought it in July, from 1st July to 31st December, it is only a period of 6 months. So you will charge depreciation only for half year. So that means 10% of this would have been 5,000, and for half year it is 2,500. So your depreciation will be here 10,000 on the first machine and 2,500 on the new machine, and in total it will be 12,500. So balance carried forward will be what? $1,40,000 minus 12,500. How much it will be? It is 1,27,500. And next year it will be brought forward, balance 1107 to balance brought forward. How much? 1,27,500. Okay. Now, if during this year the first machinery is sold, okay, maybe on say 1st October, if this machinery is sold for 50,000, what will be the entry for selling it? Entry for selling will be bank account or cash account debited to asset account 50,000. Okay, so entry on, this is on 1/10, this here is 07. So on 1/10/07 by bank, how much? 50,000. As I have told you earlier, if the machinery is sold during the year, we have to charge depreciation on the day of selling it. Okay. Now you see this machine has been sold on 1/10. That means up to 30th September we have to charge depreciation. That is for 9 months. Is that right? So if your depreciation is 10,000 for the whole year, for 9 months it will be how much? It will be 7,500. So entry for depreciation will be passed, that is depreciation to machinery on this particular date by depreciation. How much? 7,500. Now you have to calculate whether you have made profit or loss on sale of this machinery. For this you have to find out the book value of the machinery on the date of selling it. So let us find out. Cost price of the machine was 1 lakh. Depreciation charged, this is how much? 10,000 in the first year, again 10,000 in the next year. This is 2005, this is 2006, plus in 2007 also we have charged 7,500. That means 27,500. Now the book value is how much? 72,500. And if we sell it for 50,000, then we incur a loss of 22,500. Now this loss of 22,500 is to be booked to profit and loss account. So what will be our entry for that? Profit and loss account debited to asset account with this amount, 22,500. And posting of this will be done like this: by P&L account, 22,500. Now this machine we have dealt with. Now at the end of the year we will have to charge depreciation on this machinery. That is 5,000 rupees, 10% of cost price. So on 31/12/07 by depreciation 5,000. Okay, and now balance carried forward will be by balance carried forward 42,500. Okay, now this balance will be carried forward on 1108 like this, 42,500. Actually this amount represents this machine. Okay, on this machine depreciation of 2,500 was charged in 2006 and 5,000 has been charged in 2007. That's why it is 42,500. Now I will tell you how asset is shown in the balance sheet under this method. Okay, this is the balance sheet for 2005. Here the asset will be shown at 1 lakh less depreciation charged during this year, that is 10,000, and 90,000 will be shown in the outer column. Similarly, in the balance sheet of 2006, asset will be shown at 1,40,000 less depreciation charged during the year, that was 12,500, and 1,27,500 will be shown in the outer column. Similarly, in 2007, balance sheet of 2007, the asset will be shown at how much? 47,500 less depreciation charged during the year 5,000, and the outer column you will show this at 42,500. Remember, this is the second machine we had bought during 2006 for 50,000, and on that depreciation for half year 2,500 was charged. That's why in the 2007 it is being shown at 47,500, and in 2007 we have charged full year's depreciation, that is 5,000 over it, and that's why its closing balance is 42,500. Now I will explain you the method of recording depreciation, wherein we have the provision for depreciation account. The salient feature of this method is that the asset, till it is sold, it remains at its purchase price. All the depreciation charged is charged to provision for depreciation account. Okay, and another point is that at the time of sale of the asset, whatever has been credited to provision for depreciation account on account of depreciation for the particular account, for the particular asset which is being sold, is taken out from provision for depreciation account to asset account. That means provision for depreciation account is debited on that day with the amount of depreciation till date charged on the machine or the asset which is being sold, and it is credited to asset account. And due to that, the asset comes to its book value at the time of making its sale. Okay. Now I will explain you the journal entries which are made and how account is made. Okay. Let us see. As in our earlier example, the machine is bought for rupees 1 lakh on 1105. The entry is asset account debited to bank. And on 31/12/05, depreciation is charged for 10,000 rupees. Entry is depreciation account debited to provision for depreciation. Okay, and because of this, this provision for depreciation account is being credited by depreciation account 10,000, and this is being written off to profit and loss account here. Depreciation is written off to profit and loss account, but asset account is being carried forward to the next year at the price we paid for it or its cost price. And similarly, the provision for depreciation account is also being carried forward. And in the balance sheet, this will be shown, that asset will be shown at 1 lakh, and from this depreciation charged on that machinery till that date, in this case it is 10,000, will be deducted from that, and in the outer column it will be shown at 90,000. Okay. Now in the next year, in the asset account, this amount has been brought forward, and on 1706 we have bought another machinery for 50,000, this one. So that entry is there. Again, this amount is being carried forward, no deduction of depreciation as such. And on these two machineries, depreciation of 12,500 has been charged. So here in 2006, balance is brought forward 10,000, and depreciation on these two machineries is charged for 12,500, and this depreciation of 12,500 is carried forward to the next year. And whatever depreciation has been charged this year, that is 12,500, this is being written off to profit and loss account. So in this year, in the balance sheet, the asset will be shown at rupees 1,50,000, and from that the depreciation charged till date, that is 12,500, will be deducted, and the asset will be shown at 1,27,500. Okay. Now in the third year, this 22,500 provision for depreciation is being brought forward, and the asset is brought forward at 1,50,000. And in this year, the first machinery which we bought for rupees 1 lakh is being sold on 1/10/07. This is being sold for 50,000. Now we have to charge depreciation on this machinery for 9 months. Full year depreciation is 10,000 and for 9 months it will be 7,500. So we have made this entry. Depreciation account debit to provision for depreciation on the date of making sale of the asset. So in this case depreciation has been charged here. Okay. Now this machinery of 1 lakh on this till date means up to the date of making its sale, total depreciation of rupees 27,500 has been charged. That is 10,000 in 2005, 10,000 in 2006 and 7,500 in 2007. Okay. Now this total 27,500 will be taken out from provision for depreciation account and be shifted to asset account. This, and for this the entry is provision for depreciation account debit to asset account. I have not made that entry there, but the entry is provision for depreciation account debited to asset account. Okay, that's why this amount is going from this place to this place. Okay. Now this, on the sale of this machinery we have incurred a loss of how much? We have incurred a loss of this much, 22,500, and this entry for this is profit and loss account debit to asset account. And if you look at it, this total accounts for rupees 1 lakh, that is the machine. So it has gone out of the asset account 1 lakh. Now the balance carried forward in this machinery is only this machinery, the second machinery, 50,000. Okay, it will be carried forward to the next year. In this year, at the end of the year, we will charge depreciation of rupees 5,000 on this machine, which is left with us. 5,000 will charge, and in this year the balance sheet will show this second machine at its original price, that is 50,000, and from this depreciation charged on this machinery up to 31/12/07, that is 7,500 will be deducted and machinery will be shown at 42,500. Is this system clear? Only thing I will repeat again is that in this method the asset always is shown at its cost price, and whatever provision, whatever depreciation we charge, we keep on crediting that to provision for depreciation account, or sometimes we call it accumulated depreciation account also. And only at the time of sale, whatever depreciation has been charged on that machinery till date is shifted from provision for depreciation account to asset account. Entry at that time is provision for depreciation account debit to asset account. Because of this, the machinery comes to its book value, like 1 lakh minus 27,500. So machinery comes to its book value on this day, that is 72,500. Now we sold it for 50,000, incurring a loss of 22,500. So these three figures total becomes 1 lakh. That means this goes out of the system. Is this clear? Okay, now I will be dealing in this lecture on 2-3 minor things, like sometimes there is a change of method of charging depreciation, or sometimes the life of the asset is revised, or sometimes machinery is, or the asset is revalued. All these topics I will deal now. Now we will discuss the change in method of charging depreciation. Normally it is done in pursuance of any change in accounting standard, or if legal requirement requires us to do so, or if we feel that the new method will give us better results. And whatever the difference in depreciation because of change in method, this should be disclosed. Now how we go about doing this, the effect of change in method, let us understand that. Okay, this is a machinery account given to you. this company is charging depreciation at the rate of 15% per annum on reducing balance method or written down balance method, right? So this company bought on 1105 a machinery M1 for 150 and on 1705 another machinery M2 for 40,000. At the end of the year, they charge depreciation on these two machineries 25,500 rupees. On this, the depreciation has been charged for half year because this is there for only for half year. Okay. Again, they bought another machinery on 1106 for 60,000. Let it be M3. Okay, and they charge depreciation on these machineries. And on this machinery, the depreciation has been charged for only 3 months. That is 2250. And again, the machinery number 1, M1, is sold on 1707 for rupees 90,000. And depreciation has been charged on this machinery for 6 months. That is 8,128. And the loss incurred by the company on this sale is 10,247. The company has charged depreciation of rupees 13,380 on now M2 and M3. That is on reducing balance method. And balance carried forward is 75,820. Now in the year 2008, the company desires to change its method of charging depreciation from written down value method to straight line method at the rate of 10% per annum. Okay. Now what is the procedure for this? Now in this case, we have to consider only those machineries which are still with us. For example, M1 has been sold. We won't consider it at all. Now at the moment we are holding M2 and M3. Now this difference or this effect we have to give with retrospective effect. That is from the time they are with us. Now M2 is with us from 1106 and M3 is from this time and M2 is from 1705. What now we have to do? We have to find out the depreciation charged by the company on these assets up to say 31/12/07 by written down value method. And similarly we have to find out what would have been the depreciation if new method, straight line method at the rate of 10% per annum was there. Now whatever the difference comes, if the difference is, for example, you have already over, and in case the depreciation has been overcharged, then that means the value of machinery is less with us. So machinery account will be debited and P&L account will be credited. And reverse will be the case if the depreciation is charged less. Okay, let us see how we calculate this. Now first, in case of machinery M2, it was bought for 40,000. Now we have to find out its value as on 1108, because whatever the difference comes, we have to do the adjustment entry at the beginning of 1108. So we find the difference up to from the date of buying the machinery up to 31/12/07. Okay. Now this machinery was bought for 40,000 and the rate of depreciation is 15% written down value method. Since this machinery was initially bought for how much? 40,000 on 1705. That means only we shall charge for 6 months. That's why 7.5% depreciation was charged on total value. It means 40,000 multiplied by 92.5% will give us the book value after charging depreciation. Okay. Then if we multiply this figure by 85%, this will give us book value after 2006. And if we multiply this figure by 85% again, this will give us the book value of this machine at the end of 207, that is 2007. So this is the value. Okay. If we reduce from the cost price the book value as on 31/12/07, we get the depreciation charge on this machinery up to this period, that is up to 31/12/07. Okay, now let us find out what would have been the depreciation if we had used SLM, that is straight line method, at the rate of 10%. Now 40,000 is the cost, 10% is the depreciation. Now this machinery has been with us for 2.5 years. That means 40,000 into 10%, 4,000 per annum depreciation multiplied by 2.5 years gives us 10,000 of depreciation. Now as per written down method we have charged 13,268, and as per SLM 10,000. That means on machinery M2 we have overcharged depreciation up to the extent of 3,268. Is it clear? Now let us see machinery 3. Now cost of machinery 3 is 60,000, and this was bought by us on 1/10/06. Okay, and in this year we had charged depreciation on this for 3 months only. Okay, that's why 3.75, 15% divided by 4. Okay, now 60,000 multiplied by, or you can say 96.25% of 60,000 gives us book value at the end of year 2006. And if we multiply this by 85%, we get the book value of machinery 3 at the end of 2007, and it comes to 49,088. Now this means difference of these two figures gives us the depreciation charged on written down value method during this period. Is this clear? Okay. Now depreciation as per straight line method on this 60,000 into 10% into 1.25. That means this 25 represents 3 months of 2006 and 1 represents 2007. Okay, that means basically 1500 is depreciation for 2006 and 6000 is depreciation for 2007. So this comes to 7,500, and difference of these two figures give us the depreciation overcharge as per written down value method. If we total up these figures of overcharge for machine 2, 3,268, and for machine number 3, 3412, it comes to 6680. That means the balance with us in the machinery account on 1108 is 75,820. If this amount which has been overcharged earlier is put in the asset account, entry is machinery account debit to profit and loss account. If we put this entry, it means this will become 82,500. It means this will be the value of machinery M2 and M3 as reduced by depreciation, from the date of their buying up to 31/12/07. Okay. Now let us charge depreciation in the last year. Naturally, now we are using the straight line method, and according to straight line method, 4,000, that is 10% of 40,000, will be charged on this machinery, and 6,000 will be charged on M3. So 10,000 depreciation will be charged, and the balance will be 72,500. We can verify the correctness of this 72,500 also. Like M2, 40,000 is its cost, and on straight line method depreciation for 2,000 5 will be how much? 2000, and for 6, 7, 8 it will be 4000 for each year, for 3 years 12,000. So 40,000 minus 14,000, it is 26,000. This is the book value as on 31/12/08. Okay. Now for machine 3, the cost is 60,000 and depreciation for 2006, that is for 3 months, 6,000 divided by 4, 1,500, and for 2007 and 8 at the rate of 10% of original value, 6,000 for 2007, 2008 6,000, 12,000. 60,000 minus 13,500, it is 46,500. If we add up the book value of both the machines as on 31/12/08, we get 72,500. This is our value as on 31/12/08. That means we have carried out the adjustment for change in the rate of depreciation as well as method of change in depreciation. I hope I am clear. Now we will discuss change in the estimated life of an asset. We should keep on estimating the life of an asset. Sometimes we may feel that it is going to last less than we expected, and sometimes we may feel that it will last more than we expected. Okay, now let us see how we have to give the treatment in accounts. In this case, cost of the machinery is 1,20,000 and expected scrap value is 20,000. So depreciable value is 1 lakh. Useful life 10 years. So depreciation per year on straight line method will be 10,000 per annum. Now after 4 years, its book value is 80,000. That is 1,20,000 minus 40,000. That is depreciation at the rate of 10% per annum for 4 years. So its book value is 80,000. Now we re-estimate its life. We feel that instead of 6 years, 6 years are still with us, but it will work only for 4 years. That means we must write off this 80,000 rupees in the next 4 years. But scrap value definitely we will get. So 80,000 minus 20,000, which is our scrap value. So 60,000 divided by 4, the remaining life of the asset, the depreciation per annum to be charged from this year onwards will be 15,000 per annum. Is it clear? Okay. Now let us deal with another aspect where the revaluation of assets is done. Revaluation of asset may sometimes enhance the value of assets and sometimes decrease the value of an asset. If the value decreases, then that difference, the decrease, must be debited to P&L account. But if there is an increase in the value of asset, then it should be credited to revaluation account, which is not open to drawings, etc. Okay, let us understand how we have to give treatment in our books. In this case, book value as on say 1106 is 1 lakh and its expected scrap value is 10,000. Okay, so that means 90,000 is depreciable value. Useful life is 10 years. So on SLM, the depreciation per year will be 9,000. After 4 years, book value will be how much? 1 lakh is cost price minus depreciation at the rate of 9,000 for 4 years, 36,000. So book value will be 64,000. On revaluation after 4 years, we find that this machine is worth 72,000. Hence there is an upward revision of 8,000. And this shall be credited to revaluation account. Okay. Now this 72,000 rupees is to be written off or depreciated over the remaining life of the asset, which is 6 years. Hence the depreciation to be charged from this year will be 12,000 rupees. Is it clear?